I'm Meg Green with AM Best TV. European insurers are facing a myriad of challenges today, a very dynamic environment. And joining us to discuss this from our London office, we have Greg Carter, Managing Director, Catherine Thomas, Senior Director, and Mahesh Mistry, also Senior Director. Thank you so much for speaking with us today.
Thank you.
Thank you.
So if we could start with the big headline, Brexit. Catherine, what are you seeing there? How is the industry responding?
Well, the way we see it is that it's really about the ability of insurers to conduct cross-border business in the EU single market. So losing that is really a pressing concern for Lloyd's, the London market, and other UK commercial insurers. Less of an issue for the retail sector because they tend to be writing domestic business. Now, about a year ago, over a year ago, we saw insurers beginning to put contingency plans in place and looking at establishing EU subsidiaries to be able to continue to access business in the EU post-Brexit. Over the last 6 months, what we've really seen is those insurers now accelerating their plans and not just thinking about the ability to continue to write that business, but becoming increasingly concerned about the ability to continue to service claims on existing policies, with some contemplating and beginning to execute potentially expensive Part 7 transfers of historical liabilities to the newly established subsidiaries.
I think there's one thing not to lose sight of, the fact that all of this doesn't necessarily create any new insured risk, or insurable risk, so it's not generating anything for the top line, but it is taking something off the bottom line in terms of expenses to execute those responses.
Yeah, and it's absolutely, it's two types of expenses. It's both the operational expenses associated with setting up these new subsidiaries and the operational implications of that, but also capital costs as well. There are capital costs associated with setting these up and potential reduction in capital fungibility as well across group entities.
Is there a risk with uncertainty around the final details being ironed out?
Yeah, absolutely. And I think insurers are now part of the reason why they're now accelerating plans. Initially, it was just contemplating what they would do and thinking about contingency plans, but the level of uncertainty, the fact that there is still no real clarity as to what a trade deal is going to look like between the UK and the EU 27 countries. That's why we are now seeing insurers accelerating their plans to establish these subsidiaries, and also that concern about the ability to continue to service claims on existing policies.
So staying for a minute to the traditional insurance arena, what kind of market dynamics are you seeing today?
Yeah, I mean, the European insurance markets are extremely diverse, and there are countries, for example Spain, where you see exceptional combined ratios being produced by the market, but then there are other ones, for example UK and France, where you see that the combined ratios could be relatively marginal. So the competition is there and is expected to remain there in the market. But it's not only the insurance risk that companies have to contend with. You have the economic risk with the low interest rate and low inflationary environment at the moment, which could change down the road, and there's also the geopolitical risks that are also there. So what we are finding is that companies are having a very close look at the portfolio, the book that they have, and looking to use capital a lot more efficiently to remove those underperforming classes and concentrate on higher margin business. And this is leading to other, say, M&A activity in the market.
I think a lot of these markets are dominated by motor business, and that particularly has been under pressure. And I think, to your point, that is where we're seeing more companies look at alternative lines of business, so aside from motor, and where there's been pressure on motor performance, performance in other lines of business is often offsetting that.
I think there's a number of other factors also influencing M&A. It's a traditional response when management run out of growth opportunities to seek M&A in order to try and keep the top line growing, in order to keep their management busy to a certain extent. But I think there's also an impact of Solvency II that encourages M&A to a certain extent, and that comes really because of the diversification benefits that companies receive in their capital calculations under the Solvency II regime. So buying a different book of business, a diversifying book of business, can actually reduce companies' capital, overall capital needs, without necessarily adding to the bottom line. So you can have companies that are seeking growth or are seeking improvements in their return on equity, pursuing M&A as a route to achieving that, without necessarily generating more cash earnings at the end of the day.
And we've seen that with a number of big announcements being made, obviously with the AXA and Excel. But if we look on the life side as well, we've seen a number of significant sales of those savings books, which consume a lot of capital, and companies are trying to get away from that, move into capital-like products to utilise their capital more efficiently. So it's not just on the non-life side, the life segment, we are seeing some action there as well.
I think what's also interesting is part of it as well. There's, one thing is there's quite some excess capital in the market, and debt is relatively cheap at the moment. So financing deals is fairly easy. But at the same time, insurers are also responding to different threats. So we talked about market conditions, and I think particularly in the reinsurance sector, there really has been in recent years an increased focus on a perception that scale and relevance are increasingly important. So we're seeing quite a lot of consolidation in that sector. One of the other threats, though, as well, is where some insurers, particularly, say, on the retail, smaller commercial side of business, is under pressure from technology. It's business that's becoming increasingly commoditized. And there, for those type of insurers, specialty insurers that perhaps are writing business that requires more underwriting expertise are proving attractive as a means of diversification and ability to access a different type of business that maybe isn't under the same pressure as their current core business.
Are you still seeing a lot of interest from third-party capital, the so-called alternative capital, coming in?
Certainly, we saw that some of the alternative capital did suffer at the end of 2017 with the natural catastrophe losses. What we did see was that capital reloaded very quickly, and if you look at the total capital supporting the reinsurance sector at the end of the year, despite those losses, it's probably greater than it was at the start of 2017. So there's no diminishing of the appetite from alternative capital providers. There is logically a sort of saturation point that you reach in terms of the types of business that do suit being serviced by alternative capital, by short-term capital structures, and typically that's risks that can be easily modelled and not sort of bespoke exposures. So that there is a sort of natural limit to how much business could be supported by alternative capital, but I don't think we've reached that limit yet. But what we clearly see is there is further appetite from alternative capital suppliers to enter this marketplace, and despite the tests of 2017, we're not seeing any reduction in that.
Just like to add is that what we are seeing, a lot of the focus of companies is not really growth nowadays. Now, growth is important, but in the competitive market that we have today, that's not their primary focus. It's about getting a certain ROE to their shareholders and trying to attract the right quality of business, going through the appropriate distribution in order to do that. And that means that companies are focusing more on those high margin classes, looking at cost efficiencies in order to meet their hurdle rates going forward.
So there's a lot in the news lately about potential trade wars. How might that impact insurers?
I think we see a number of potential issues for insurers. Clearly, a trade war is bad news for the economy, generally speaking. There will always be some winners in a scenario like that, and particularly as countries focus on stimulating domestic demand and domestic production. The challenge for the insurance industry is what does that mean for insured goods and insured values? And any slowdown in trade generally is not a good thing for the insurance sector. It typically means fewer transactions, fewer goods in transit, potentially lower levels of production globally. So we think it's a threat to the industry. The difficulty is knowing the magnitude of that threat, and without understanding how a trade war potentially plays out, it's difficult to get a handle on that. But it's certainly on the radar. We'd expect management to be considering the challenges that poses, and to have that on their risk register and to be considering it.
Aside from just the impact on the economy as well, one consideration as well is the ongoing access of that insurers and reinsurers have to business overseas. So if there is increased, if for example, I mean the Brexit's a example of that, where there is reduced access to business across borders, then that clearly for international insurers and reinsurers is a negative. They're unable to diversify the same way and write as much business. Perhaps for domestic insurers that can be a positive because there is reduced competition in those domestic markets. So it depends where you sit there.
Right, well, thank you so much for speaking with us today. Mahesh, Catherine, and Greg, it's been great to have you here in Oldwick.
Thank you.
For AM Best TV, I'm Meg Green.